Their glasses have cameras, and you can voice and gesture commands to basically a device that is going to be tethered either to your phone, to your computer, and then you could capture video. You can ask it AI questions like, "Hey, what's this or what's that?" So I'm imagining employees wearing these glasses. And right now, let's say you're in a warehouse or inside of a store or something, a lot of barcodes are prevalent in, let's say, a Home Depot or a Target. And usually employees have a handheld. Well, these glasses could replace that handheld, because you could just look at the barcode and it could scan it, and it could show you the information you need basically on a screen that's integrated with your glasses. Frees up the employees so they have both their hands completely free. That's good. And I think it would be very convenient for employees just to walk around with these Meta glasses and now have one more device to help them do their job. Whether the person's working in a warehouse or whatever production type of facility we're talking about, a retail location, maybe you're doing you're at an event, right? You're doing crowd control, and you wear these glasses. You're capturing images in case there's a situation that you got to take video. You have video integrated into your glasses. So as they describe this new business, I thought that the business cases had a lot of merit. So I'm excited about it. And it's caught Apple's attention. Now Apple's trying to get into high gear over these, glasses that are an extension to our devices, like our handheld phones and our computers. So I think that's going to potentially be a new area of innovation. Now, for some reason, Meta's selling off, and it's been selling off recently. You see that they hit $780 a share back in September 18th. A couple weeks later, we're down to $713. And this stock has done well for the year, 24.7. Year to date, 22%. So this has been a good performer. And if you look at the 5-year chart, you see that the market really gave us a great opportunity that I took back in 2022. You could have bought shares less than $90 a share. You could have bought shares for like $86 a share. And now it's trading for $715. So this stock here is got an interesting, and I think a very valuable future. And it's going to be interesting to see how Meta takes advantage or capitalizes on the AI area. The glasses potentially will be an area that they innovate in. They definitely are investing in their AI apps, and it'll be really neat to follow. It gives me more conviction to keep my Meta shares. I own a lot of Meta. Like, I own over $300,000 of Meta, and I'm not selling any shares. I think their future is really, really good, and I'm glad to own their shares. Any thoughts on Meta that you have, Daryl?
It's not one that I own, but I do respect the company and what they've been able to achieve. Let me pull up a Meta chart. They definitely have done very well. Let me get to one of my standard charts that we look at all. That way I don't people with different charts. Okay. So this is one that I have invested in the past. I didn't hold it very long because it really didn't fit my investment style that I'm in right now, which is I'm in early retirement, waiting for Social Security. So I need really more income type investments. So I held Meta for a little while and then decided it didn't really fit my strategy. So I traded it for some other stocks. In retrospect, that probably isn't necessarily the best decision, but it is what it is based on my strategy. So I don't know. We probably should look at least 3 years with, and we can see that they were trading at 132 at the time, and now they're sitting near 714. So pretty much a 6x increase in Meta shares over that time without necessarily a whole lot of volatility. I wouldn't say I've seen a whole lot worse. Let me put it that way. So let's look at just 1 year. Looks like the 20-day is starting to roll over a little bit and could cross below the 50-day. And if it gets anywhere close to this 200-day, it's probably worth jumping on to it with both feet, because it doesn't test that 200-day very often, but it looks like it actually is on a path at the moment to do just that. I only see one test. That was in April to get below the 200. That's over the past 2 years. Looks like it got below the 200 somewhere, in 2022. So that's no surprise, because 2022 was negative for most, at least tech stocks, the big tech stocks. So
Yeah,
if it gets anywhere close, go ahead.
Yeah, and Meta in 22, man, I think it got more than its fair share of sell off. It
Yeah,
really sold off. Some others didn't do as bad, but it was really sold off in 2022.
yeah. And I see a lot of buyers here just under the 200-day. So I don't expect it to go much below that. If it comes down and tests this, it looks like it could test it probably, I don't know, between 675 and 700. If this trajectory, this is a pretty steep sell off here. If this trajectory stayed, then it could get down to about, I don't know, 700 or so, and that would be right around where the 200-day moving average would be at that time. And that'd be I think that would be an entry point that you probably shouldn't miss.
Excellent. Thanks, Daryl.
Yeah, the RSI is down below 50. The PPO is also down below 50. They've had a little bit of distribution since the 4th of June. I don't know what that it's going to take to reverse that, but we'll see what happens.
Great. So let me cover my valuation of Meta. So right now, Meta, in my opinion, is discounted by 30%. And that means that I think it has a price target of $1,022, measured by its value based on free cash flows and its value based on profits. So that's a 30% discount. So if I were to buy any shares at this time, I'd be buying below intrinsic value. The cash flows are excellent for the business. Their growth is really good. They're growing at 20%, and they're a huge business. They have very high margins, 85%, very desirable business. So if the market wants to sell it off, man, it's just dangling one more opportunity with this company. I own a lot of shares, but man, if this stock got down, let me be a little creative in my thought. If it got down to like $650 a share, I'd probably have to pick up a few shares, even though it probably is violating some kind of risk management rule that, hey, you shouldn't have too many eggs in one basket. But hey, it's Meta. I'll put more eggs in that basket. So that is Meta. The next stock I wanted to talk about is Berkshire Hathaway, Warren Buffett's company. And they made some news with the announcement that they're going to acquire the Occidental Chemicals business for like $9 billion. And they have plenty of cash. They're probably going to write a check and run out of room with all the zeros they're going to have to put in there. And the company, this is a $1 trillion market cap business. And I'm actually thinking, should I buy a lot of Berkshire? Why am I thinking that way? If you look at my portfolio, it has a lot of growth. It has a lot of technology, communication services, financials, especially some, smaller financial businesses. Like Robinhood was a small cap at one point. Now it's bigger, but I have a bunch of others that are small caps. And as I look at Berkshire, it's a collection of companies, and the companies that I do like, they have the insurance business, Geico, they have railroads, they have utilities. Somehow they have, and think about like the utility stocks have just been going crazy. Well, Berkshire owns utility companies. It's like, geez, man, they're either really lucky or really smart or both. So I'm thinking, this might be a decent investment from a long-term perspective. What would I get out of it if I decided to buy into Berkshire? Well, I'm going to get stability. And this is one of the stocks that if we have troubled waters, like the market's scared, they run to Berkshire. They're like, oh my God, everything else is not working. I want to go to Berkshire. Those guys know how to manage these times. It's like buying a giant mutual fund, but they don't have a management fee. It's just you're buying a fraction of the business that owns other businesses. As we look at the stock year to date, this one I don't think it's keeping up with the S&P. The S&P is higher. And for the 1 year, it is not keeping up with the S&P. For the 5 year, it is beating the S&P by a little bit. But it's got a beautiful chart up and to the right. That's what I want to see. The PE on the company is 17, forward PE 23. And this business is a collection of a portfolio of publicly traded stocks that they have in their 13F filings, in a collection of privately held businesses like Geico, which is completely owned by Berkshire. They own some utility companies. They own See's Candy, which I would never buy See's Candy, but they bought it. They think it's a good business, and a variety of other businesses. As we look at their business growth, not a whole lot of growth in 2024. They did see some growth in 23. They did see some growth in 22, 21. Now, everybody had a contraction in 2020, so I don't see that as a bad moment for them. Everybody had a bad moment. Big revenue company, $370 billion. So that looks very, very good. And then their free cash flow. Free cash flow has been declining. And I think, I'm not quite sure why, but this decline is probably why the stock hasn't been flourishing in the current year, in the last 12 months. So if they can get back to these high free cash flows, I think this stock's going to continue to work, because it provides, investors pay a premium for it. And I think it's worth it. This is kind of a little bit outside my most desirable zone because of the margins. Margins are not very good. They own a lot of businesses that are low margin. And, that's just what you're buying into Berkshire. And this is interesting, right? Berkshire is this giant company, but not a lot of analysts want to state an opinion. I think they don't want the pressure of putting an opinion out there on Warren Buffett's company. They could run the risk of getting fired by their bosses who are like, you said something, critical of Warren Buffett, you're fired. Revenue growth, they're expecting some revenue growth in the future. And as I look at the business, again, they own some utilities. They own some railroads. I'm not excited about the railroads, but I am excited about the utilities. These guys know how to manage utility companies. And they're also a big investor in Apple. I'm not excited about the Apple investment, but at least the Apple stock has been sold off to some extent. Earnings per share is going to grow at a good rate. So those things look okay. And when I look at the valuation that I have of Berkshire, it's fairly priced. It's priced with a 2% discount. My price target on Berkshire is $512. per share for the B shares, not the A shares. And each share is trading for $501. So this is kind of an idea I've been kicking around. I don't own any shares. Don't know if I want to own shares. But as I look at the big gains that I have in 2025, I'm like, okay, I don't think this is going to last forever. I think the market's certainly had a great run coming out of April. How do I lock in those gains and set myself to have a good year 26, 27, 28? Well, I got to think a little long term, and maybe I need a little more stability in my portfolio. So that's where I'm at with Berkshire. You have any comments on Berkshire Hathaway?
Yeah, they've got an interesting looking chart at the moment. So they've been on a downtrend since the 2nd of April with the tariff announcements. They reached their low on the 7th. They also touched it again in August. But one of the fascinating things here, you were talking about safety and stability. They pulled down 13%. What was the S&P during April?
19% down.
Okay. So it was 5% less. I thought it was more than that. So I've drawn a downtrend line, and they are breaking above that right now, which is to me somewhat of a positive sign. I think all of this was him holding on to so many treasuries when the AI recovery and what have you was going on. They were getting punished a little bit for that. But it looks like the market is starting to pay attention to them again, and they are breaking above a downward price action. Their RSI is just at 60 right now, and their PPO is positive. Looks like we had maybe another bullish crossover today. So from a purchasing perspective, this is set up the way I like for them to set up for me, my buying style.
Very good. Yeah, and this one's a little bit of, as I get older and I want to be more, have my portfolio be more stable. Like I'm willing to trade maybe a little bit of the upper end of the performance of a portfolio, but what I get out of it is more stability, less negative volatility. So we'll see. I'm going to give it some thought and see if I want to jump into that stock. Thanks for covering that. The next stock I wanted to talk about, and Daryl, if you have any stocks you want to talk about, please let me know. I'm going to cover United Health, and then we have a couple of requests, but in between the requests, if you have a stock or two that you wanted to cover, we can cover those. So United Health is, boy, talk about a rough year. Their stock was trading way up here at $645 $645 a share. As recent as April, it was up at $594. And then, the market just took this stock down 60%. And there was some stories there that had some very tough, storylines around it. CEO getting assassinated. Yet after that, a CEO resigned and said, "Hey, I just don't want the job," and he gave it to somebody else. You had stories that the government was going to investigate their practices. So it was a little bit of a, negative news followed negative news situation. And as I looked at the fundamentals of the business, the fundamentals still looked really good. And since it hit a low, the stock's really flourished. It's up more than 50% for the investor that wanted to buy into this stock and really load up on what is a really valuable business in a traditionally stable industry. United Health over the long haul, it's been a winner. Look at this. Look at this chart. If you saw this part, eliminate the last 6 months, last 9 months, be like, wow, that's a really, really good stock. They've gotten things done. And you include the last 6 months, it looks pretty ugly. So United is doing what I thought it was going to do. It's on its way back to $600 per share. And what I'm seeing the market do with the stock is very encouraging. It's also encouraging to see a lot of famous super investors buy United Health, Warren Buffett being one of them, Michael Burry, David Tepper, Chase Coleman. These guys are really good investors. And they're looking at United saying, that's a very good opportunity. Give me some shares. And those guys buy hundreds of millions of dollars of these shares. Me, I've got a substantial position, but it's not up there with those guys. Those guys are big hitters. So United is really moving. It's I was curious to see what the forecast was, see where these analysts are, see if they have any backbone. Got 24 analysts, and they think it's discounted. All right. And this analyst, I'd probably get along with this analyst. They're at 675. And then this analyst is like, hey, this business is really broken. It's really priced too high. And on average, they think there is a discount available on United Health. Now, the business is going to continue to grow. That looks good. That growth looks good for a giant business. $452 billion of revenue in 2025. And it's growing nicely at 13%. So if you grow 4% on 450, we're talking about $18 billion of dollars added to the top line. And that's more free cash flow, more profits available to the company and its shareholders. So that looks really good that it's been positive. And it's been positive along the way. Okay. And I guess one of the statements, or the reason why the public in some cases despise insurance companies, is that they're profitable. They grow, while some people feel frustrated when they're in the claims process. And I get that. I don't think insurance companies are ever adored by the public, but it's a very good business. Earnings per share are going to grow really nicely and expand. And earnings per share are really, really going to be good. So the fundamentals look terrific. Stock looks good. It's on its way higher. And it is so fun to see, gratifying, that when you see a stock that's just, the market's just beating it up left and right. And for months, I've been saying, hey, I think United's a good opportunity. It's a good opportunity. I've been saying it for 3-4 months. And it's discounted. I think it's discounted at least by 27%. I'm taking a very conservative valuation approach when it comes to United, and it's discounted. So I already loaded up on United. And if it has any dips, I buy more shares because I want it to be a top 10 holding in my portfolio. It was at one time a top 5 holding in my portfolio. I owned it for years. I sold it 2022. I was very happy with the rate of return. It was a very good rate of return. And that's why I was a little bit, in disbelief when the market was just selling it off so much. Is it's selling off a really good business. The market sometimes is very irrational. Not that it was being very irrational on United Health. So it's good to see that stock go. I would love to see the charts on United Health if you wouldn't mind covering those.
Sure. This is one we've looked at quite a few times, and probably a month or so ago, I drew this downtrend line. And once it broke above that is when I continued buying. I actually started buying back in here. So I have a cost around $298 right now. But once it broke above that line, that was a very strong signal, and it did that on a gap up. And then it consolidated for probably 3 or 4 weeks. We had another gap up, and it's consolidated. And today we had another gap up. So I had this line at around 298. That's my average cost, but that's not why I have it on there. That was the point where I was going to definitely pick up some more if it pulled back to there. And that was around this particular time. So that was the setup, and why I started buying pretty heavily once the chart was reversing this downtrend that they had for quite some time. The 200-day is still downward sloping. And if you look right here, this is a shooting star candle, but I'm looking at the market overall, and it looks like the Dow is down about 33% from its high today. The NASDAQ was positive, now it's red, and the S&P was up quite a bit more than it was earlier today. So this shooting star, I think we're probably going to see quite a few of those today, just because the overall market is down. So we'll have to keep an eye out on that when we look at other charts to see if that's the case. But if this was exclusive to UNH, this would be a cautionary flag or candle, because that would tell me that there's probably room for some downturn. But I'm not quite as concerned about it here, just because the whole market is pulling back since the exuberance this morning on the service PMI report. So they're.
I have a quick question for you.
Okay.
So, I remember Tom Lee, right? He was analyzing the chart when we saw that big sell-off in March. It kind of ended April 9th. And he said, that the recovery is going to somewhat match the trajectory of the sell-off. Okay. And hopefully that makes sense.
For UNH or?
No, for the market, for the
Okay.
for the S&P, for the market at large. And now I'm setting up my question on United Healthcare. So looking at charts, do you believe that the recovery in the stock will be somewhat at the same rate, opposite rate of the sell-off? Because the sell-off has been quite dramatic on the stock. It happened over 4 months, 5 months. It's sold off 60%. So would you expect this stock to come back very quickly if it sets up that, hey, it's beginning to recover?
I think it could be a pretty symmetrical pattern that we see. So they had the CEO that was assassinated last November.
Yeah.
And then I can't remember the exact date of all these events, but this may have been the legal action against them. And then they had one more where they pulled their guidance. And CNC Centene is another healthcare provider that I own. They had pulled their guidance either right after or right before United. I can't remember which one pulled it first. But those were the two big gap downs. We are almost to the point, if I put my cursor here, we are almost to the point where we're refilling this gap. So this gap down, and now we're sitting about right there. So looks like we only have probably 3% to go, and we'll close this gap here.
Okay.
And then we'll be working our way up if we continue on this trajectory, because it does look like it takes 2 or 3 weeks of consolidation before some news.
And I have more questions when you're ready.
Okay, go ahead.
Because believe it or not, I've been paying attention to you on these live streams and learning something. And so, toward the left of your screen, and I don't know if you're going to be, I don't think you're going to see my icon, but it shows that there was a lot of buyers at these lower prices. So these buyers were are kind of set, right? They have a good price that they're holding.
Yep.
So as we move up in price, there is not going to be a lot of stranded longs that would be eager to get out. Like, oh man, I can't wait to get out of this stock because it's been a dog for a year and a half kind of situation.
Yep, you're right. So we have a big shelf of buyers right here. So that was from 329 down to 303. So anywhere in between that price range, we had a lot of buyers.
Okay.
And I was buying, I'm part of this group right here. So I'm set pretty good right now. I've got a lot of, I've reduced my risk on this one quite a bit at this point. So this is definitely just let it run. And I'm pretty confident that we're going to have a little bit of, let me go back out to 1 year. We're going to have a little bit of resistance at the 200. You always do. Whenever you reach these, then computerized algorithms start kicking in. So they're going to be looking and watching that number. Technical traders watch that number. So we'll battle here for a little bit and then really like to fill that gap. And then, who knows where it goes from there.
Yeah, very good.
And if we get any news on these legal issues being cleared up, or they settle or do something like that, then it's, to me, is going to go probably back up to the previous highs without any problem.
Very good. I remember when I owned United Healthcare, I bought it like 7 years ago and maybe 8. I owned it for like 4 or 5 years, and the dividend was super low, but I didn't really care. But it was like 1%, 0.9%. And it was because the stock price continued to go up, right? So no investors are going to complain, oh, this dumb stock, it went up 50% and now my dividend is lower. I've never heard an investor complain that way.
No.
But now with the stock dropping so much, if you locked in a lower price, you're at a 3% yield on your dividend. So it's kind of a double winner. You're seeing the appreciation of the stock. And if you look at what you paid for the stock, you have a 3% yield on the dividend.
Yep.
All right. Thanks for doing that, sir. We're going to go over some requests now. And right before I jump into that, it looks like the healthcare space is doing all right today. We have some big stocks selling off, Meta selling off, Palantir selling off, AMD, Tesla. They are not having a good day. A lot of sell-offs there. And financials are having a good day. Very good day. So there is a lot of green on the heat map, but there's some red spots on the biggest caps, like Tesla's down 3%, Meta down substantially, Palantir down 7%. We got to look at Palantir. What's going on there? So we're going to look at Accenture next. And Accenture is a professional services company. The stock has not been doing all that great. And this is a request by, I think it was Mitch that requested Accenture and Zoetis, and cool comments on pets, by the way. And I do agree with that, with those storylines. A lot of people love pets, especially around the pandemic era. It seemed like pet adoption just went through the roof. Okay, so Accenture, they provide professional services. So if a business wants to modernize, create some new applications, or maybe business consulting and so forth. Now, high level is this, these guys are in a very prosperous industry, which is a lot of technology. They're kind of near the tip of the spear on activity. And I agree with that. But the piece that holds them back is their margins. So when you look at this business, you're not dealing with a Palantir. Let me open up Palantir just to show you how awesome their fundamentals look. I don't own Palantir, by the way. I think it's priced too high, but that's a separate conversation we'll have later. But a software company like Palantir has 80% gross margins. So when they sell $1,000 of revenue, $800 is gross margin because you wrote the code once, you could sell it to 1 million customers. Your incremental cost per customer, not that much. Accenture, on the other hand, they sell $1,000 of additional professional services. They have to get a professional resource to do the work. It costs money to hire that person, to pay that person, benefits, all that good stuff. They got to buy all the incidentals like laptops and technology and office space. And all those things add up and they shrink the gross margin. This is why Accenture has a limited valuation, okay, is their gross margins. That's why I look at gross margins. Gross margins enable me to classify a business properly because a business I could easily get confused. Hey, these guys are involved in a bunch of AI projects. Yeah, it's great, but it's kind of like if you're a short order cook and you're flipping burgers, but you get to flip burgers at the Super Bowl. It doesn't make you a Super Bowl, resource. Like you're not on the field with the teams. You're flipping burgers and maybe you can charge double because it's the Super Bowl. People are willing to pay a little more. You're still limited in how much earning potential you have. So Accenture is a business that has been sold off the market during a time where everybody's crazy about AI. And Accenture would tell you that, oh yeah, we're all over AI projects, doing a lot of professional services there. And I would say, really? Well, why aren't you growing by 70% like Palantir? Man, Palantir growing 38%. Now they're not that big, but 38%, that's really good. Accenture's not growing that fast. Going to the quarterly, 7% is good. They're a pretty good outfit, pretty big outfit. So those are the pieces that are kind of, first, I don't think Accenture has an overly desirable business. I think it's okay at best. Their growth rate is not exciting. So that's a problem. So we've got a business that's sold off. Margins are limited. What do analysts think about this business? Then I'm going to show you my valuation. So this is based on earnings per share, 21 analysts. They think it's highly discounted. Some analysts think it's worth a lot more, $392 price target. And the worst price target is $240, which is right on where the stock is priced right now. When we look at they have a fiscal year that ends August 31st. So they just ended their fiscal year for 25. And now they're already operating in the fiscal year that will end August 31st of 26. And they're going to have that growth. That makes sense. That stable, nice growth. Okay. Earnings per share is going to grow as well. All right. So that's where that's at. Let me show my valuation. And I don't know if you have charts on Accenture, but we can move to your charts after that. So here's Accenture. And with the stock price being sold off, this is discounted by 42%, both using a free cash flow method and an earnings per share method. Now, I think Michael Burry has made it a habit of buying stocks, not necessarily because he loves that industry and he loves that type of business, but because the stock is really offering him a very compelling opportunity to buy at a discount. I'm feeling that way about Accenture. The market really doesn't like it for whatever reason. I kind of shared my sentiment that they don't have great margins, but value is value. 42% discount on a very well-known business is fairly compelling. It's compelling me to think about buying the stock. And I like what I'm seeing. I think Accenture is a buy at a 42% discount. And I'm going to do some more homework on it because that is a pretty attractive proposition for me as an investor. And they pay a dividend, I believe. They pay a dividend. So for income investors, they pay a dividend of 2.66%. So I like Accenture. What do you think?
You're probably not going to like what I have to say.
Well, I started off bad mouthing Accenture, and then I ended with I think it's a buy. So the audience is ready for anything now.
Yeah, I'm looking at a 10-year chart. So back in 2015, this was definitely an investment. I mean, you had some pullbacks, but those are not to be unexpected. And then it hit a plateau here. And that's at the end of 2021. And since that point, it has done nothing but trade in a range. So it's been consolidating for 3 years. So, if I had bought it anywhere back here and 3.5 years later, it's at the same price. I had a lot of excitement at times. I had a lot of disappointment at times, but at the end of the day, I still have the same amount of money that I had before when there are so many other investments that have provided some returns. So this to me shifted from an investment to a trading asset. This would have been great to trade here. Just using technicals, get in, get out, and you probably could have still made a lot of money. I know a guy that did that back in the early 2000s with a company that I work for on its stock. So it didn't go anywhere for years, but it had a lot of volatility like this. And he basically ended up with a 7-figure portfolio just by trading in and out of a stock over about
Buying
10
at the
years.
right time, selling at the right time.
Exactly. So he did that over a 10-year period. So that's my opinion. It was an investment for a long time, and now it turned into a trading asset. If we just go down to 1 year, they're below a downtrend. And you've heard me many times, if you've listened to what I've been saying, that my style, I don't even start looking at them until they stop reversing, or when they go into a bearish reversal, bullish reversal. As long as they're going to trade down here, I'm not interested in owning them.
Very good. Good analysis. Thank you, sir. So that's Accenture. And the next stock we're going to look at is going to be Zoetis. And Zoetis, a lot of neat comments on pets and how that's really become a very popular thing for people to do. Totally get it. And these guys for the past year, down 23.7. 5 year. So this is where, in the COVID days, man, geez, I remember people were adopting pets at a very high rate during COVID. Understandably, right? You couldn't hang out with humans anymore. So you could get a pet and you could, probably enjoy the company of a dog or a cat or, whatever your pet preference is. So very, very, very high increase of pet ownership. And these pet owners, they pay up, man. They take care of these pets. They love them. And this stock really went up $244 a share. Since then, the stock hasn't been all that great. Let's take a look at the fundamentals. Maybe it is great. And I'm curious to see, where are these guys from an industry and sector? They are a healthcare. They are a healthcare company, and they do drugs, specialty and generic for animals, for pets. So it's in the right category. I just think it's funny because I always think of healthcare for humans. All right. So market cap, $65 billion, revenue of $9.39 billion, P ratio at 25. Dividend is 1.36. Analysts think it's really discounted, 36.35. Let's take a look at the revenue. What's their revenue been doing? Well, the revenue has been expanding. Here's that COVID bump. It's people came out of COVID with new pets, and they're going to pay up to take care of their loved family member. And they just kept growing. So why is the market so negative on this company? They keep growing. All right. Well, maybe there's something else going on that's not good. Gross profits look good. Let's see what the margin is. Zoetis just spun off from Pfizer. Man, Pfizer was those boneheads. They should have kept it. This is a growing business. So, very good point. Thanks, Ignacio.
With a lot less regulation.
Yeah. Right now, Pfizer has a growth problem, and they could have kept this business. They maybe should have kept it, but I guess they just want to focus on drugs for human beings. All right. So back to the analysis here. I wanted to look at margins and free cash flow. So we'll look at free cash flow first. I like the growth in the free cash flow. Okay. So we're seeing an increase in free cash flow. Very good. $2.2 billion of free cash flow. Look at these beautiful margins. 71%. So stock market selling off the stock that's growing and has 71% margins, 27% profit margins, close to 28. I just showed you Accenture. They were at 31, 32% gross margins. Profit margins for them was 10%. You see the difference. It's like, wow, this is quite attractive. Free cash flow yield of 23.6%. So I'm really liking these fundamentals. Let's look at the balance sheet. I want to make sure that maybe there's a balance sheet problem, and want to make sure that's not the case. So 1.45 billion of cash, 6.8 billion of debt, and that's a net debt of 5.3. If we look at debt to EBITDA, not a problem. 1.69, it's below 3. So we're good there. So I think this one's going to value quite well. Let me turn it over to you, and I can work on a valuation. I'm pretty sure I don't have Zoetis in my repository of research, so I could work on one while you do the charts.
Well, if anybody is like me, when I pulled this chart up, I had to take off my glasses and make sure they were cleaned, and I rubbed my eyes because it looked exactly like Accenture. Do you see this? It is exactly the same. Huge growth, quite an investment. Hit here, and now it's trading in a range. It is almost the same exact chart.
Interesting.
Let's go to, whoops, didn't mean to do that. Let's go down to 1 year now. And this is going to look really familiar too. They have not reversed their downtrend, which is since last September. That's when the downtrend started, and they're not anywhere close to reversing that yet. So it all depends on your investment style. I am not interested in this because I wouldn't. It doesn't pay a big dividend to start with, so doesn't fit my style. It does pay a fairly good dividend. Let's see. It is a good dividend for growth, and they probably have good growth on their dividends.
Mm-hmm.
Yeah, 0.3 to 0.5. Yeah, they probably have pretty good growth. I could go look at that and see what the 5-year dividend growth rate. So for a younger, and I am in some groups with some younger investors, and they love the fact that it was a dividend around this yield, but it had had high dividend growth, so they were interested in that. I never could get into it because it just looked like it was going down to me. But anyway, that's where we sit with the chart. Till they break through this trend line, this downtrend line, their price isn't going up; it's continuing to go down.
And you know that kind of profile you described Accenture and Zoetis as, it was kind of a multi-year winner, and then it got into this like sideways with a lot of chop. Is that kind of a label you put on a stock like that is kind of like, hey, buyer beware?
You definitely have to shift your strategy. If you're just buy it and forget it, that would have been a good thing to do in 2015.
Mm-hmm.
It would not have been a good thing to do at the end of 2021 because it went from a strong investment to something that's just trading sideways. So it
Mm-hmm.
becomes a trading asset at that point, in my personal opinion.
Mm-hmm.
Um, because if you buy it back here, you're sitting at the same amount of capital and it hasn't gone anywhere when there's quite a few other companies that are not showing that same kind of profile.
Okay.
Carter Worth, who is a gentleman that's on CNBC quite a lot, he says there's no such thing as a growth company. There are companies that are in growth phases. Those phases may last a long time. So we can see here, I don't know how far back I can go. We can see that this was in a growth phase, and people talked for 15 years that it was a growth company. And it may still be if you look at the fundamentals, but the price chart isn't showing that any longer.
Yeah, I understand that point. I would agree with that comment that, you know, it's just logical, right? Like Apple had a growth phase. Now they're not growing. Um, Microsoft has had multiple growth phases, by the way.
Yep.
So they kind of grew, they didn't grow, then they grew. Now they're still growing. So
The interesting thing about that comment, though, is it keeps your mindset correct. If it's in a growth phase, don't call it a growth company because then you think, well, I'm going to hold this thing 40 years
I
because
I
it's a
agree.
growth company. Yeah. So to me,
I agree.
it's enough of a mind shift that it keeps you alert to these
And
kinds of patterns.
I'm gonna match that up with some of these like kind of I think oversimplified rules of thumb that are actually, I think, unproductive.
Yep.
And the comment being, "Oh, this is a buy and hold forever stock."
Exactly. I
Okay.
hate that phrase.
All right, yeah. So you're telling me that Enron, you bought Enron in the '90s. You felt like a genius because your stock was up 20x.
If you bought
Yeah,
GE in 85.
GE now is back, but
Yep.
boy, it
Yep.
really abused its investors, or
Yep.
Intel, or we can go on and on. So I think the best term, I'm going to steal it from somebody who's probably going to cause half the viewers to immediately hang up on our stream. Jim Cramer.
Mhm.
I like his tagline, which is "You buy and do your homework."
Yeah.
I like that phrase, which is I like to look at a stock at least twice a quarter. What does it mean to look at it? Is look at the fundamentals. What are the news stories that are affecting the stock? And news not necessarily that, hey, the CEO is like, dating, Taylor Swift or something. Okay, that's nonsense. But what about if you own a stock and the main competitor just got a patent on a product that's going to be more competitive? Okay, how's that going to affect the stock that I own? That kind of thing, as well as the fundamentals. Like, hey, every earnings announcement, reassess, is it going down the road that it thought it was going to go? Is it doing better or worse, and that kind of thing. So buy and do my homework. That's what I try to do.
Yeah.
And I hate
I like.
that term of buy and hold forever.
Yeah, I do too. I've heard some stories, um, particularly in husband and wife situations. In this particular case, the husband was the investor. He worked for GM. The wife was somewhat passive in the investing, but he instructed her to never sell GM. Well, at a time they did really fantastic. And then because he worked for them, and he didn't probably follow risk management, but he had a lot of stock in GM. When he told her that, it made perfect sense. After he died, she never looked at that stock again, and it finally got down to below $1.
Ugh.
So that's one story I've heard. I've heard others too. Enron, I knew a guy personally that worked there and lost his entire investment. So I've heard those kinds of stories more than once. So I'm like you. I don't like buy and hold forever. I'm never going to sell it. No, I may never sell it until it isn't working anymore. But because I do hold my holdings quite a long time, people think I may trade in and out a lot. But since I've been managing my portfolio for 5 years, probably 3/4 of my stocks I'm holding from 5 years ago.
Mm-hmm.
I don't trade in and out of them. I may trim and buy and trim and buy, but I don't get out of them.
And so one last comment, and I'm sorry, I think it was, I forgot who asked about Zoetis. I have the valuation here. I'm going to cover it in a minute.
Okay.
The other thing that I didn't hear this when I was in my 20s, in my 30s, but I started to hear it when I was in my 40s and really understand it now in my 50s, is it's really easy to buy stocks. You find a stock you like the fundamentals in my case, and you like where the company's headed. It's really hard to sell a stock. And I think your form of investing is a different game than mine, which is, this thing's already gotten, like, for example, Reddit's trading higher than its intrinsic value. That one's easy. It's not hard to make that decision. I think I'm going to keep my shares because Reddit has this, it's going through a growth phase, right? I'm already adjusting, Daryl. It's not a growth stock. It's going through a growth phase. But what about Robinhood? Like, it's up 740% since I bought it 2.5 years ago. Well, you got to hang on. I'm just going to hang on to that rocket and just see how high it'll take me.
Well, they've got something going on. I'm not a stockholder in that one, but they've got a culture going on that's going to take that company places for
that's what I
probably for some years.
And what's funny is I'm not in that culture. It's like, I own the arena, and inside the arena, they do all kinds of live performances, and the music, people show up and they view the music and so forth. I never watch the shows because it's not the genre I like. It's kind of like how I feel about Robinhood is I own the company, but everybody else loves the experience. I'm too old for it. I'm willing to admit. I like my good old fashioned, brokerage, and maybe someday I'll be on Robinhood. All right. So enough of that. Sorry for the delay on Zoetis. I did my valuation, and guess what? The market's right. This stock is priced 26% too high. Why am I making that opinion? I think each share is worth $108 per share. It's trading at 146. Well, what's behind that number? Well, let's look at, based on cash flows, this stock's worth $95 a share because its cash flows are not that high in proportion to its market cap. Okay. If I look at 2.3, and this is really 2.2 billion, you can see it up here, and I'm growing it by 7%. So if I take 2.2 billion and I multiply that times 20, which is what I would do back of the napkin if I had a slow grower with decent margins, I'm going to get to roughly 44 billion. Well, these guys are up there with a market cap of 65. So yeah, this one is expensive. It's like, let's compare them to, they used to be part of this mothership. And maybe that's what Pfizer sold them off. It's like, wait, we're not making enough cash. The mothership, man, they crank out cash like it's illegal. Drug dealers are envious of Pfizer. Actually, illegal drug dealers are envious of the legal drug companies. So 40% discount on cash, 36% discount overall. So maybe Pfizer is wise to have sold this company. There's good growth, but it just doesn't crank out the cash they need. So Zoetis is a sell. It is a sell for me. And the market was excited with the storylines of pets. It makes sense, right? People pay cash for the pharmaceuticals they need for their pets. I get that. But I also get fundamentals rule the day for me, and I'm not gonna buy. So that is Zoetics. Two really interesting stocks. I thought I was gonna hate Accenture. I actually like it, and it's a buy. I thought I was gonna like Zoetics, and it's a sell. It's a contrarian day. All right, so let me check the chat. And is there a stock you wanted to look at, Daryl?
Just one that you were talking about Meta earlier.
Uh-huh.
And the only reason I bring this up is I happen to own a company that they have an agreement with. You mentioned utilities a couple times.
Mm-hmm.
And Meta signed an agreement with Entergy Corporation. They're going to provide the data for their new data center in Louisiana. And the original reason I bought this is they happen to be my electricity provider. So I bought enough of their stock where their dividends would pay my electric bill every month.
There we go.
So anyway, they did exactly what I wanted them to do. Every quarter, they were sending me enough to pay my electric bill. So I still haven't paid an electric bill yet because they pay me.
Uh-huh.
But then it broke out. It turned into an AI stock.
Look at that.
Look, yeah, it's broken out 3 times and it broke out again today.
Wow.
I don't know what's going on. This is a utility company. They provide electricity. I expect them to do this. I do not expect them to do this. But this thing has already returned all of its capital back to me in less than 5 years.
Nicely done.
I mean, this is crazy for a utility company that nobody's ever heard of. I'm about the only one I've ever talked to in any of these groups that even knows who this company is. So anyway, I thought I'd mention that because you were talking about utilities earlier and Meta and a few other things, and it's just interesting to see a stock do this when it's totally unexpected.
So let me ask you a couple questions on this, and it's more about like, okay, so you're sitting on a winner. You still own the stock?
Yeah, it's a huge winner. I can show you. I have my trades here.
And where I was going to go was, are you considering selling or are you considering like, I'm going to hold? And if you're considering selling, do you find that to be easy, hard? Any comments there?
I never have a hard time selling. So I purchased as many as 2,310 shares. I'm holding 520.
Mm-hmm.
I sold 80 shares about, let's see, October. No, that was last year. July, I sold some shares.
Mm-hmm.
And it's basically because it had become more than I wanted to hold in my portfolio.
Mm.
But so I've spent a total of 119,000. I currently have invested 26,000, which is market value is 46,000.
Mm-hmm.
Been paid 9,000, almost 8,500 in dividends. So they've returned all their capital to me. My adjusted net investment is below zero at this point.
Who said money doesn't grow on trees? It does. Look at this. It's a very good investment.
Yeah, I've had 41 trades that I'm green on and 2 where I've lost money. And on the 2 that I've lost money, it was $415 compared to 54,000 on the 41 buys that I've had. So
that's awesome. Congrats.
And this is a utility company. I mean, I'm not buying a AI stock here.
You accidentally did.
Yeah, I accidentally did.
So I have a request from Mike. he wanted to see if you could please show Elevance, ELV, and Molina Healthcare, MOH. He wanted to see the charts and see if they are
MOH.
resembling what we've seen with United Healthcare.
Need to. Oops, my computer is running a little slow, but there it goes. Okay, MOE. Yeah, it looks pretty similar, doesn't it?
Yeah, isn't that interesting?
Yeah.
And I think the government's messaging that, hey, I think they were going to strip away a lot of funding into healthcare. I think there was a bill that took away a lot of funding. I think that was part of the sell-off in UNH, and most definitely it affects Molina Healthcare.
Yeah, if I didn't know which chart I was looking at, I would think it was UNH, but they look really similar.
They do.
I didn't mention that UNH yesterday broke out of a 13-week new swing high and a 65-day new swing high. That was yesterday. It looks like Molina might be doing that today. At least 65-day. I don't know about the 13-week. Let me look real quick. Let me go to a weekly view and see if they're breaking out. Nope, it's not 13 weeks. It's only 11. So they've got at least another week or two before they hit a 13-week swing high. But UNH hit it yesterday.
Interesting. And can you show Elevance? And then I wanted to show
Sure.
something on those three stocks.
Looks a little different than UNH. UNH was a pretty sharp downturn. This one looks like it's a little longer. Yeah, so it looks a little different. It looks like they're getting ready to break above a downward trend. So you guys probably get tired of me drawing these lines, but there's something I do every day when I'm deciding on stocks. So they're getting pretty close to crossing above this downward trend. That'll be a really good sign.
Okay. And how's Elevance doing today?
The 50-day is
And Elevance is
starting.
up 3.27. Molina Healthcare is up 3.89. They're having a real good day.
Yeah, and they're not quite a shooting star like I showed on UNH. Let me take another look at UNH and see, it's still a pretty good shooting star. So ELV is really not. And the 50-day is turned over, the 20-day is turned around. The 200-day will be doing that probably within the next week or so if this pricing continues.
Interesting. Well, let me show something. When we look at those three stocks, and today it looks like Molina's really rising quick, almost 4%. And what news came out of Washington that's causing this? Are they going to fund healthcare, or what's the story that's coming out of Washington?
Isn't it a holiday, some kind of a holiday, Jewish holiday? So I don't think they were doing much talking today.
Well, there's got to be some news that's making healthcare go up higher. But anyway, let's take a look at.
Is it just healthcare?
Well, I'm looking at these three stocks, and I'm thinking, what is the news that is affecting, health insurance payers? Is it that there's some type of agreement in Washington that's going to be made that's going to help these companies? Maybe. I don't know. I
Yeah,
haven't
I
seen that.
don't know.
So over the last month, it looks like Molena's really gone up nicely, 14%. Elevance has gone up 9.34%. UNH has gone up 16.95. So they're all trending in the same direction at different rates. Over the last 6 months, this is where it gets a little ugly, is United Healthcare is down 33%. Elevance is down 22%. So it didn't get sold off to the level that UNH did, but Molena got sold off even harsher, 42.8%. Wow. That is a sell-off. And let's go with the 1 year. So 1 year, UNH and Molena are kind of in the same rate of depreciation, but they're both recovering nicely. And Elevance kind of didn't go down to the extent, but it got taken down with the rest of the health insurance payer space. It took it down by 29.45% over the last 12 months. So that is Molena Health and Elevance. All right. So see if anything's changed in the stock market. Looks like Tesla's not down as much. I'd like to look at Tesla before we're done. Palantir. We looked at Meta, and healthcare is still doing fairly well. A couple red spots, but UNH is doing well. We just covered Molena and Elevance are doing great. And we've got the med device space doing well. Lilly, J&J doing well. Pfizer's doing well. Okay. Utilities are doing great. Energy. Exxon's doing great. Yeah, Exxon might be interesting to look at too. All right. And for the index itself, let's see here. So there's still this shutdown looms into next week. All right. Dow is up 0.64, S&P up slightly, the Nasdaq's down, and the Russell is getting it done, 0.78%. Nicely done. All right. So let's take a look at Palantir. Why is this stock down so much? I did see there's a story.
Is the second worst sector of the day.
Well, there's a story that Palantir software is susceptible to cyber attacks. I think that's a story that's taking the stock down. So that's the story. But the stock's just, man, what a stock, huh? Just going up and to the right. It doesn't care what the market thinks. This is such an extremely successful stock. And it's a $414 billion market cap stock that has revenues of just $3.44 billion. That's a pretty small company. Okay. You're paying 120 times revenue. That's a pretty tall premium. P ratio 579. Again, premium. Analysts it's priced a little too high. It is a good grower. This is impressive. Okay. That it's growing, and quarterly, you see the acceleration. That's impressive. Okay. But it's at some point, the growth will be harder to come by because you'll be growing on larger numbers. It just gets harder and harder over time. And I think that's, when that's going to happen, I don't know. And mostly individual investors, retail investors are the ones that have bought Palantir. It's not like big institutional players have bought Palantir, and they are flourishing with this stock. I don't think they're eager to sell it. They just want to see it continue to go higher. The free cash flow again, back of the napkin. This is a good growing company. And I would say if you multiply this by 30, you would get a valuation of roughly 51 billion. Let's say you're like, well, maybe I multiply it times 40. I would get a valuation of roughly 60-70 billion dollars. So we're a distance from its valuation. And I'll show you my valuation of the stock. I just don't even come close. The margins are good. Margins are very good. Free cash flow margins very good. I don't doubt that. It's just the top line is so darn small that it's hard to value this stock. Now, I'm not the only one that thinks, hey, you got to look at the fundamentals and do the math. There's an analyst that's at a $45 price target. On average, 139. There is an analyst that has a price target above its current stock price.
How about if you filter it for top analyst only? Looks about the same, huh?
Yeah.
Okay. Thank you.
And then the growth is going to persist. And look at that. It's supposed to even accelerate when they're twice the size that they are today. Actually more than that. So right now they're about 4 billion. So they're going to be like 2.5 times bigger. They're supposed to keep growing and actually accelerate growth. And if that's the case, I mean, this stock's going to keep working. I just don't see it letting up, because that's more evidence that this is a really, really special company. But we'll see. Execution's the name of the game. So overall, it's an interesting day for Palantir. What's the 1 month? It's still up 11% over the 1 month. 5-day, it's down a little bit because of today and yesterday. And my valuation on Palantir is not very good. Not very high. And I think the stock's priced 64% too high. If I just treat the fundamentals, kind of like take the name of the company off, take, certain identification off of who they are, just look at the fundamentals. This is how they value in my mind. So I think it's a interesting stock that it continues to go higher, but it doesn't pay attention to its valuation. It just continues to go higher. What do the charts look like for Palantir on your side?
Well, this one's a bit cluttered. I'm going to see if I can't clear things up just a little bit to make things easier to see. So I'm going to take off my 5-day moving average. Before I do that, let me show you the 50-day and the 200-day. They are nonstop up and to the right. The 50-day will level out, but it rarely turns down. So that's an important thing. So what I'm going to do is just I'm going to dim these down to where you can't see them, so I can focus on the 21-day moving average. So there was, first of all, I mean, it's just straight up and to the right. The 50 days still upward sloping, 200 days still upward sloping. And whenever I have this 21-day EMA on here, I would have started getting concerned about right here, but it would have been a false concern. But look how many times it just comes down and tests the 21-day and just keeps going up and to the right.
Yep.
So in fact, I have owned this one in the past. It was for fun, just because it was on such a run, and I just wanted to play with the trade. It's not one that I would hold per my regularly scheduled strategy. But every once in a while, I have some fun money, and I'll trade stocks like this. So as long as it keeps doing this, I would be hanging on to it, because when I did own it, I did make quite a bit of money on it.
Mm-hmm.
Today was a gift. If you believe that a 20-day test, if you believe it's going to hold this, which I think it probably will. If you get a software development team focused on correcting an issue as major as what was reported today, they can do that fairly rapidly. You get a hotshot team on it, and they can fix those kind of faults pretty rapidly. So it's not like you're having to, redesign a booster rocket for something that's going to go to the moon, where it takes years. Software is much easier to fix than that.
Mm-hmm.
So this to me would be a gift. You're talking a $12 price change, and it came down and just tested a 21-day moving exponential moving average would be a gift to me.
Excellent analysis. I cannot argue with it. Palantir has just really been a successful stock for many.
Look at the accumulation. It has not stopped. It is just straight up.
Look at that. Incredible.
They've had they had a couple of days here where the money flow was negative, and they had 1, 2, 3, 4 weeks there, a month in July where it was negative. Other than that, it's all positive money flow into the stock. Looks like the NASDAQ has improved a little bit. It's not down quite as much as it was, and the Dow is moving up too.
Yeah, it's interesting. The market as a whole has how it just continues to go up. I think the small caps are kind of leading the charge, which is good. It's healthy to have like some more companies rally versus just the same names continue to go higher. Like today, right? Palantir's down, but the market's up. All right, cool. Meta's down, but the market's up, and that's good to see. All right, so let's take a look at Pfizer. Looks like Tomas was asking about Pfizer, and that's a quick one. I cover Pfizer so often that it's easy for me to roll out of bed and cover Pfizer. Now, Pfizer for the longest time, it's just been not doing what I thought it was going to do because the valuation's a very good one. Like it produces a lot of cash. It's this business here is somewhat a victim of its own success. It came out with a vaccine during the COVID years. It made a lot of money, a lot of free cash, for 2 years. And the stock would run up nicely. Then the market kind of left it for dead. It went from 59 and it's got down as low as 22. So it's just a stock that was like, geez, so sold off. It was an opportunity, I thought. But I've been in the stock for quite a while, and like 18 months, and it has not done much. So the recent rally we've seen in the stock is kind of a good thing to see, but I'm not convinced just yet. I'm waiting to see if it's establishing a more longer term rally. It pays a huge dividend. It was even higher if you bought it at a lower price, but right now it's at 6.26. It's a $156 billion market cap stock. The growth is a little deceiving because it's showing 13% growth on the trailing 12 months. But if you study the guidance, they're actually guiding that they're going to be flat for a while. So they got to figure out how to grow. That's their problem, how to grow their revenue. they are growing the bottom line, which is kind of a way that like Johnson and Johnson, they do that very well. See how the growth in top line is just not going to be there. They're trying to grow the bottom line, which they did quite well this year. And the stories coming out of, Washington is they met with President Trump. They found a way to lower drug prices. And I think that type of partnership with the White House is probably going to serve Pfizer well. They're probably going to be placed in a good position going forward, is my observation. So I'm not overly excited about Pfizer. It's not a buy in my book. I own a little bit of shares. I was actually in the process of selling out of Pfizer, and I sold probably 85% of the shares that I owned. And I'm hanging on to the remaining shares just to watch the stock. But I used the sell-off in the stock to accelerate my getting out of the stock. I'm like, okay, this stock hasn't done much. I'm going to use this as an opportunity to get out while the getting out is good. And if they can figure out how to grow and create some long-term reason for me to be more optimistic and have a better sentiment about this company, then I'll consider buying into it. But for now, I'll keep my capital on the sideline and find other businesses that look better. Do you have any charts on Pfizer?
Of course.
All right.
So they just broke out of a 65-day swing high and a 13-week swing high. And they've been up for the last 4 days based on that agreement. I did hear they make it sound like they are not going to be charging so much for these drugs and what have you in this agreement. Most of these are generics, which Pfizer already sells at a pretty low price. So it's really not going to affect them financially, is what I'm hearing. And then they're getting basically a 2-year or 3-year waiver on tariffs related to pharmaceuticals, where others that aren't playing the game are going to have 100% tariff on name brand pharmaceuticals. So Pfizer is going to be excluded from that now. So I think that's going to help Pfizer. And I just did a little bit of research this morning. And if they can get back to their 5-year average PE, they're going to be at about $32 to $33. So that's where I'm expecting them to be in 12 months. They are a little bit oversold or overbought at the moment, but that can work itself out through time or a little bit of a pullback.
Mm-hmm.
So this excitement has driven the price action pretty high. The PPO is positive, and even though the RSI might be flat, the PPO is not yet. It is still accelerating higher. So I think it looks good for PFE, and they're a dividend payer, so that's why I'm going to hang on to them. I don't blame anybody for stepping out of this one because it has really been hurting for a while.
Yeah.
But I think they're in pretty good shape.
If you think Pfizer is looking pretty good, let me show you OSCR Health. It's up 12% today. And boy, this stock has got, if you would like volatility, if you want a little excitement in your life, be an OSCR Health stockholder. These guys are a health insurance payer that's really trying to grow, and they have a very fertile, a very large addressable market. But man, if you look at the stock from August 1st, it's a $13.58 stock. Now it's $21.60. That is a very, very big move, 50% or so in a month, actually in 2 months. So that's looking good. Now, OSCR, I own, and I kind of just make sure that, It's not completely going off the rails, but it's going to have a roller coaster ride. Um, I'm glad that I continued just to hold my shares. I actually bought shares as recently as August timeframe where I'm pointing, and I use these times to buy into this stock. The growth in the stock is there. It is really there. 48% growth. It's hard to find periods of growth for companies that is that high. It's just hard to find. And it's also hard to find it with a company that is producing positive free cash flow at the same time. So that combination is what I'm looking for. That's what I was looking for when I got Robinhood. I loved Meta. That's worked out really nice. Coinbase, um, TSM back when I owned it, and I did really well with that. So this is a recipe for success that I have, and I've really the one thing that is wild about this stock is the volatility. Holy smokes. It's not typical of the stocks that I buy, but this one is pretty jagged. Over the 5-year, this is looking like a crazy ride, which it kind of has been. But again, I go back to that rate of growth on the top line, and it's pretty darn impressive. Analysts are not convinced. They are real naysayers on Oscar, but I'm convinced, and it's my money that's being invested. They expect that next year, the revenues are going to go down, and I don't agree with that. I don't know where they're getting these forecasts. When I look at their financials, I'm actually seeing that they're going to continue to grow. So I'm not agreeing with what these analysts are putting out there. So no top analysts cover Oscar. That's interesting. I should have clicked that to begin with. So interesting. All right. And when I look at Oscar from a valuation perspective, still see a 39% discount on an exciting business. And I'm using a very high discount rate because it is a wild ride with a smaller cap. But man, if they could just keep growing, you keep growing that top line, great things are going to happen. If they keep, like the Robinhood story, they keep substantiating the story that they started to write a couple of years ago. Oscar Health, the story they're telling the market is, we want to be the big player for individuals and small businesses that need health insurance. It's a very fragmented market. There's no one big player. And if they become that one big player, I think it's very valuable. United Healthcare doesn't want that space. Elevance doesn't want that space. They want to go to one employer and say, oh, you have 100,000 employees. Beautiful. We'll do business with you. We're going to have a big amount of revenue from you, big profits, big cash flow. But I think there's a big opportunity now that we have great systems, AI, for a business to really dominate in that space, which is a very big space. And if they are successful there, I think it's going to be a 20 bagger, a 30 bagger, because their market cap is still fairly low, market cap of 5.4 billion. I mean, this could easily be a $100 billion, $200 billion market cap company over the next 10 years. So I do want to keep my ticket for this show. Any thoughts on Oscar? Can you make sense of that volatility, Daryl?
Oh, not really, but something that you said is kind of interesting. This price to volume bar, price by volume bar, the largest bar here that's in the buying territory happens to be in the lower half of this cycle, which is tells me that there's a lot of people like you that every time this thing dips, they're buying. And it's right at that price, about right there. Anytime it comes down from these highs to about right there, they're buying up shares. So they're collecting a lot of shares at that price range. That was kind of interesting when you said what you said.
Yep. And Mike has a good comment, which is Dave, which is a different stock, makes Oxford look tame. He's right about that. But if you're going to play with these small caps that have high growth and their stock prices are flying, that's what we're going to get. So, all right, we're coming around to the market close. What's this market going to do here? Let's see. Oh, it's Dow's up nicely. Look at that. It's not a bad rate of appreciation for a day. And the Russell is up a little higher. The S&P is in the green, and the NASDAQ is down just a little bit. When we look at the heat map, the same companies are still in the red. Tesla did come back a bit. Okay. So we're just going to keep trending higher. So for the 1 year, S&P is up 17.96%. Year to date, it's up 14. This is a very good year. If this was December 31st and we were kind of closing out the year and we could stamp 14.32 as a appreciation on the S&P, that's a good year. It's a good year. If we can hold that, or if it goes up a little higher, if it goes up a little lower, it's still a good year, especially considering that we had a very good year in 24, a very good year in 23, 3 consecutive very good years. I'll take it. Over the 5 year, you would have doubled your money if you bought the S&P ETF. You would have doubled your money, which is a great rate of return. And I heard, so I was listening to an interview of the great Peter Lynch. I am a fan, but I don't follow much of what Peter Lynch has to say. And I would say that it's going to be a little bit kind of harsh, I guess, is Peter Lynch invested in the 80s, and he was very, very successful. And it was a different time. And he was very successful. He had a very good rate of return. For a while, he was the best mutual fund manager in the market. I owned his Magellan fund, and I was happy with the rate of return. Around that time, I also owned the Bond Kings fund that had, he was really good with bonds, and he would compete with stock portfolios. That's how good he was with bonds. And that was Bill Gross. And nowadays, ETFs have kind of pulled, disclosed that a lot of these mutual fund managers are not that great. And you're paying them 1% to 2% to be not that great. And ETF investing has really become a huge, huge part of the market. Can't blame people. If you bought the ETF for the S&P, you're doing great. You're up 100%. I don't know that anybody should complain about 100% rate of return over 5 years. And if you do your homework, you can beat that rate of appreciation and so forth. And where I'm going to is the interview with Peter Lynch is a lot of the stuff he was sharing. This is an interview that happened either today or yesterday. And again, I have ultimate respect for him because when I read his book, Went Up on Wall Street, geez, I overread it 30 years ago, maybe longer. It made sense. But now most of what he talks about, it's like, does not apply. It's like, I don't think that is a good idea. Most of the things he said, he had a different way of thinking about stocks, and I don't think it applies anymore. And I think that's old school thinking. And the markets, I think, I'm one that would say, you got to think for yourself. You got to gather information. The information's out there. The data's out there. You got to do your own analysis and make your own decisions on portfolios. That way you could achieve a high rate of return. You can keep getting better. And old school thinking is, hey, you got to go find a good mutual fund manager and just stick to them. It's like, no, not for me. Oh, well, you got to get a good advisor who's going to give you really good advice. Well, I tried that too. And it actually was a step backwards, and I was paying somebody. It's like, okay, I don't want that either, unless I have somebody that's really good. And if they're really good, they're probably like a Chase Coleman that's making billions of dollars. So the ETF investing route has been really, really successful. If you look at Vanguard, they have trillions of dollars over at Vanguard because of their ETF selection, and it's been a good one. So sorry to go on a rant.
I agree with you. I have a lot of respect for all of the really successful investors, but I don't like to hear people say they're going to follow that particular methodology 100%, because those guys have totally different mindsets and plans. It's quite possible than what you have. So even like somebody like Buffett, he doesn't buy for the next 30 or 40 years or until his retirement, because he never retired. He's buying for 100 years. His company is going to be around forever, long after he's gone, long after the current CEOs are gone. That company's going to continue on forever. So operating exactly like Buffett did, even though I have the utmost respect for him, would not work for me. So we have to keep that in mind and brush up our own skills and become our own successful investor, because we have a personal plan that we can't just simply follow someone else.
Yeah. And you kind of, you make a good point that, you gotta pick out the lessons from each investor, that, because I think they do have some wisdom in what they're sharing.
I'm
Like
with
the one
you
that's
there.
the one that I've probably think, man, most of what he says is aligns with the way that I invest, is Pat Dorsey. He will present in front of universities, like small gatherings, like he'll present to finance classes and stuff. And he also wrote a book, this little book on investing. I'm like 80% of what he has to say, I'm like, I agree with that. But like back to Peter Lynch, he once said something that I just was like, man, that's so wrong. One of his sayings was, don't ever invest in a company that doesn't make a product you can't hold in your hand.
Yeah.
So you can't buy Google, you can't buy Meta, you can't buy Microsoft, you can't buy Palantir. You basically eliminated what has been, a treasure chest of value in the last 20 years. And so it's like, hey, it was a different time. Maybe back in the 80s, yeah, you didn't want to go deep with software companies, even though if you had, you would have made a gazillion bucks. All right, so let's go ahead and land the plane. We're 4 minutes from the market close. Looks like we're going to close to the upside and just end the week on a positive note. Well, thank you, sir. You got any big plans this weekend?
I don't think so. Just a lot of rest and relaxation.
Good for you. Yeah, ditto. I think I'm just going to take it easy and get a few things done. But I do have a plan to go out and maybe go for a hike or two
There you go.
this weekend.
It's too hot here for that.
It's beginning to get to that good time of the year.
Yeah.
Where it's chilly in the morning and chilly in the evening.
Yeah.
And warm in the middle of the day. And I like that time of year.
Yeah. Very good.
All right. Well, Daryl, you have a nice weekend. And everybody, thanks for tuning in. Have a great weekend, everyone. And
Thank you.
You guys take care.